back. Take a look at futures this morning, about 1 hour away from the opening bell for a Monday. And this gains across the board after the Federal Reserve's surprising 50 basis point cut last week. The Dow Industrials right now up 27. The Nasdaq is up 49. The S&P higher by 9 points right now. Atlanta Federal Reserve President Raphael Bostic is a voting member through year end. He spoke about the Fed's decision to cut rates this morning. He says, quote, taking that step does not lock in a cadence for further moves. My approach to policymaking will be guided by the incoming data, input from business contacts, the evolving outlook, and the balance of risks. Joining me now is Piper Sandler's chief global economist, Macro Research, Nancy Lazar. Nancy, great to see you. Good morning to you.
Good morning. Nice to see you.
So you say the last two times that the Fed cut rates by 50 basis points, which was in 2001 and 2007, recession followed. Is that right?
No, that's correct. And to be sure, Chair Powell is worried about the labor markets, and we would agree with that. We would agree with the need to do a 50 basis point cut because our leading indicators are definitely still pointing in the direction of a recession. The unemployment rate isn't up much yet, and there's a big debate about how much of it is due to immigration. But a measure we call cyclical employment, which is payroll employment excluding the government, healthcare, and education, has been declining for 6 months in a row. And that is a classic recession signal. That's what was going on in 2001. That was what was going on in 2007. I want to make it clear we're in no way making the comparison between '07 and today. It's just that the recession actually started way before Bear Stearns. It started in in December of 2007. And so we're just highlighting that indeed the 50 basis point cut does not really reduce the risk of a recession.
Yeah, I mean, look, 2006 and 2007 was quite the moment in time, I think we all agree, when Bear Stearns was acquired by J.P. Morgan. I remember the first time I realized how serious things were was when Jamie Dimon said he would pay $2 a share for Bear Stearns. Remember that? And then eventually,
yes,
he paid $10. But yes, you're right in terms of the different backdrops here, 2007 and today. But look, we've got a big week of economic data, right? We've got the final read of second quarter GDP out on Thursday. The Fed's preferred read on inflation out on Friday. That's the August PCE index. So, Nancy, go through some of the metrics that you're looking at. What are you expecting from this week's data? And how long does it take for an interest rate cut to start trickling through the economy, Nancy?
Yeah. So this week in particular, we'll be watching certainly unemployment claims. We don't expect claims actually to increase until the fourth quarter. You did have a drop-off in layoff announcements earlier in the summer, but now they've picked back up as we go into the fall, and that classically leads unemployment claims. So claims very well could stay low right now. But that's, again, not the clear employment metric to be looking at. The one that's best is indeed cyclical employment, which, again, is already declining. First, you stop hiring and rehiring, and then you lay people off. And I agree with Powell that is likely to happen in the fourth quarter. So claims aren't likely to be that right signal quite yet. We'll also be watching mortgage applications for home purchase. A difference between a soft landing and a hard landing is in a soft landing, housing does pick up because of lower rates, and the unemployment rate doesn't increase significantly, and cyclical employment does not decline. So we'll be watching the mortgage bankers data also on Wednesday. Within the GDP data, the thing that's going to be interesting is kind of old news, but we're watching corporate revenues very closely, particularly the non-Mag 6 corporate revenues, which stalled out in the second quarter, which helps explain why you've seen cyclical employment actually decline. And on the inflation side, given the deterioration in the labor markets from an employment perspective, that's why inflation has slowed. Consumers can't afford these higher prices. The fast food industry, auto companies, they're not cutting prices out of the goodness of their heart. They're cutting prices because they are seeing weakening demand. And you clearly saw that last week with FedEx, which shipping is a great cyclical indicator, highlighting that the consumer is pulling back and companies are cutting price to try to gain share or maintain share.
Well, I mean, it's true. If you're looking at what's happening in business, you get a good window into the broader macro story, right? It's one of the reasons that you watch spending from corporations, right? And the CapEx situation. So how would you characterize CapEx right now in terms of companies laying out additional allocations of money and funding for things like IT and R&D and those big ticket items, Nancy?
Yeah, it's called a business cycle for a reason. Businesses drive the cycle, both jobs and capital spending. Secularly, we're very big bulls on the U.S. manufacturing renaissance and CapEx. The digital economy, innovation, AI, et cetera, is a very, very important part. But capital spending is very cyclical. And we just got business confidence for the third quarter from the Business Roundtable. It kind of stagnated, shifted down a little bit. Companies are pulling back on CapEx. At best, it's bifurcated. You are still seeing some strength in the build out in the digital world, both computer semiconductor plants and also data centers. But other than that, you're really seeing weakness. The other data to look at this week will be durable good orders. Again, ex-defense, durable good orders in unit terms, in real terms, are actually declining, a precursor to a decline in capital spending on equipment. And then in addition, non-residential construction spending dropped in the second quarter, despite the strength in semi-plant construction and data centers. It dropped in the second quarter, and we think it will drop again. Commercial real estate is really under pressure, from office buildings to warehouses. And so at the end of the day, you are seeing a shift down in capital spending. We think it will decline a little bit as we go into 2020, 2025.
Yeah, but which is why I want some historical context from you right now and trying to understand how long it takes for these rate cuts to, trickle through the economy. I mean, you write in one of your most recent reports, on average, it takes 10 quarters after rate liftoff for a downturn to commence. This is the 10th quarter, and given the size of the rate hikes and the Fed's balance sheet drawdown, joblessness could reach 6%. So flip it on its head and tell me what it means in terms of how many quarters it takes for the rate cuts to work through.
Yeah. So this is the 10th quarter of the after liftoff, and so we think odds are going up now significantly of indeed the economy tipping into a recession. On average, it takes about 10 months for rate cuts to help turn the economy around, with big variability. In 1980, it only took 3 months because Volcker cut rates very, very dramatically, 1,000 basis points in a very, very short period of time. But obviously, it also depends upon not just those rate cuts, but also, are there negative things going on under the economy that could potentially prolong it? Again, this is nothing like a GFC, but in 2001, you had the tech bubble bursting. Today, we would say we have the stay-at-home bubble bursting, which is why you have such bifurcation within companies, particularly on the consumer, but also on the industrial side. We have way too much consumer installment debt. Thank gosh, it's not a mortgage debt problem today, but it is a credit card problem, and you have a clear increase in delinquency rates. And then last, we also have a very sharp increase in auto inventories. The IS ratio has increased dramatically. So we have these economic excesses, which also help determine the length and depth of the recession, along with what the Fed does, how quickly they indeed ease. So our base case is good news: the Fed's cutting rates, but it's too late.
Yeah, and I would add to that the fact that the border is an issue this time around, right? You're seeing job creation for non-citizens, but you're seeing job declines for U.S. citizens. That's also a little different than GFC, as you call it, the global financial crisis. Nancy, great to see you, and we so appreciate your incredible research. Thank you so much.
Thanks a lot. Have a good day.
All right, we'll see you soon. We'll be right back. Stay with us.